You're watching us here on Chartbusters. I'm Mangla Malu. With me, as always, Nigel D'Souza. We're looking at the markets. Well, they're doing not so bad. The Nifty bank holding up in the green. But let's talk about individual stocks. Larsen Toubro and the Larsen Toubro Infotech as well as Mindtree merger has come into effect yesterday, forming the 6th largest IT company in the country with over $4 billion in annual revenue. Rima Tendulkar caught up with Debashish Chatterjee, who's the MD and CEO at the newly merged company, and began by speaking about revenue synergies that will emerge from this merger. Let's listen in.
The primary objective of this merger is how do you cross-sell and upsell and create more revenue opportunities for ourselves. And the reason why we are very confident about that is if you look at the number of clients that we'll have as a part of LTI Mindtree, it's almost like 700 plus clients, and there is only 10 to 12 clients where we have overlaps, which means where we have been servicing through the separate entities earlier. So there's a huge opportunity for us to cross-sell and upsell, and that's what we are looking forward to. And that's why there will be a lot of focus in terms of providing end-to-end capabilities in terms of what we call as full stack capability, where we can do all the way from customer experience to supply chain transformation, including data and cloud. So that's what we are looking for in terms of cross-selling and upselling, and that's why we are going to focus in terms of creating revenue synergies, as we go along into this in the new entity.
How soon before you realize these revenue synergies? Can it kickstart from day one? And talking about the revenue opportunity from cross-selling and upselling, the annualized revenue run rate on day one of the combined entity is $4 billion. Do you think, say, 6 quarters down the line, FY24 end, the combined entity could be a $5 billion company? Is this a realistic assumption?
Well, I think that's what our aspiration will be. That will be our endeavor. But again, you need to also look at all the other aspects. I think to put it in a different way, if you look at the growth trajectory of both the companies, we have been focusing on profitable growth and also industry leading. And as a combined entity as well, the primary objective for us will be to continue on the journey of industry-leading profitable growth. So if the industry is growing at a certain percentage, we definitely want to do better than that, and it has to be profitable growth. So keeping that in mind, there is no reason why we should not be growing, the way we have grown in the past.
Okay. So talking about profitable growth, the combined entity EBIT margins are closer to about 17.5%, 17.3% if I take the Q2 numbers. Is this the margin range we should expect for the combined entity? And just in the near term, do you think there will be integration-related margin headwinds?
I think we have already called out that in the past, that, just to take a step back, we announced the merger sometime in May this year, and we had set a timeline of around 6 to 7 months before we can have the day one. Day one is basically the day LTI Mindtree comes into existence, which has been yesterday. So yesterday was the day one. And, there will be definitely a time required to ensure that all the systems and the processes, the way people work with each other, all these things will, this is where the rubber meets the road. And our aspiration is, based on the planning that we have done in the past, our aspiration is to get through all these things before the end of this fiscal year. That's our aspiration. And if we can do that, that's pretty much a record time by which we can achieve that. And that's the primary goal that we have at this point of time. To your question specifically, yes, of course, there will be certain one-off expenses that we'll be taking in Q3 and Q4 because of the integration cost. But having said that, if you look at our overall journey in the last several years for both the entities and now as a merged entity, as a combined entity, we will be focusing in terms of keeping our EBIT and EBITDA margins at a certain level, and then invest back into the business. That has been the philosophy as we have been growing, and that is the philosophy that we'll continue to follow as we go along. Now, to call out a specific number is a little too early, because I need to still understand, it depends on the overall synergies that we can create, etc. So you have to give us a little bit of time, but I'm sure we will find out the range at which we will operate and follow the same principles that we have followed in the past.
But can the range be higher? Because now you will have a lot of cross-selling opportunities, synergies. Even on the cost side, there will be cost optimization. So without getting into numbers, can we assume that, say, 1 year down the line, the margins of the combined entity will be higher than what they are today?
Well, that's the aspiration. I mean, if you have done this merger, there are certain rationale, and one of the rationale is that over a period of time, we should be improved. We should be able to improve the EBITDA and the margin as we go along. But please try to understand one thing. I mean, the whole philosophy of this merger is around how do you create revenue and synergies. We have been very vocal about the fact this merger is not about downsizing. So we want to make sure that the employees that we have, we can leverage them fully in terms of focusing on the markets and the revenues. So to your point, there will be definite cost synergies that will arrive at, and as we get into the for example, real estate, there will be some consolidation opportunities as we go along, because two entities may be operating in the same city, which we don't need. We don't need so much of real estate. We can combine them. So this is just an example. But I would say at a broad level, right now, the focus will be in terms of revenues. How can we create more synergies in terms of revenues? But as we go along, there will be definitely cost synergies available to us.
All right, so that was the big story of the day. The management says the cost synergies will actually be back-ended, but front-ended will be the revenue synergies for LTI as well as Mindtree. With that, we'll take a short break. On the other side, we have with us Shailesh Chaturvedi, who's the MD and CEO of Arvind Fashion. Stay tuned. Welcome back to Chartbusters. Well, the markets are trading with a tinge of red in today's trading session. The mid-cap index as well has moved into the red, and now you have more number of stocks that are declining in comparison to the number of stocks that are advancing. So the crisscross lines as well should come up for you on the screen. But it was a pretty good showing from Arvind Fashions in the past quarter. The company recorded its highest ever quarterly run rate, with the revenues growing by close to around 30%. That's in comparison to pre-COVID levels. Mr. Shailesh Chaturvedi, the MD and CEO of Arvind Fashion, joins us. Hi, Shailesh. Morning. Thanks so much for joining in. Well, it's been a good showing. I think the unlocked trade is playing out. People are shopping big time, which is good for your business. But give us a couple of numbers. I recall that y'all had guided that y'all will grow by 15% in comparison to pre-COVID levels in FY23. Now, given that you've done 2,100 in the first half of the year, should you be ending the second half, with a similar run rate? That would end at around 4,200 crores. Is that a fair number? And margins, can it hold at these high single digits of around 9.5 to around 10%?
We've had a good season. We are very happy with our, execution in the market, the sell-through, lowering of discount. Our revenue at 1,200 crores is the highest ever, and has grown really well at around 45%, and like you said, 32% over the pre-COVID time. So markets are buoyant, and our brand portfolio is very, very strong. So it's all leading to good sort of scale momentum going forward.
Shailesh, we have some of those details. What we are trying to get out of you is what's the way ahead? Second half of the year is going to be better. Can you end at more than 4,200 crores? And can you maintain these margins or better? Go ahead.
So these kind of numbers, 4,000 plus crore, it's quite possible. We have a good scale momentum right now. It's very likely that we will hit those numbers that you mentioned in terms of the scale. Margins have been improving. If you look at last 4 quarters, quarter by quarter, sequentially, and also over last year, our margins have grown. This quarter also over last year, margins have grown between 2.5% to 3%. So we see that trajectory continuing going forward in the second half also.
All right, we take that point. Now, just, above 4,000 crores, just wanted to understand, because the numbers that you've reported are the second quarter numbers. What you haven't reported and what we've seen is the kind of festive season demand that there was. Can you give us a sense of how festive season in this fiscal was versus, say, a normalized festive season?
So we are very happy with the way the festival season gone as per our plan. And if I look at this season, fall holiday season, our sell-through continue to be very good. So we are very happy with the way this season is going. And the next, we're looking forward to the weddings and the winter wear season, and the season will end in December. So on plan, the season is going as per plan.
Okay, give me two numbers, Shailesh. One, just wanted to understand, you said that you've recorded a full price sell-through across the brand versus discounted. That increased your margins. What proportion of your sales came in at full price, and how much of that was discounted? What was the proportion of that discount? Is that likely to sustain going ahead?
So, if you look at last 2 seasons, we've delivered good full price sell through. In our industry, good full price sell through will be close to 55% to 60% in that zone, where you sell full price and the remaining goods are discounted. So we are on track to beat our plan on similar numbers, Mangalam.
Okay, all right. Sailesh, I wanted to ask you about the other income. For the past quarter, it was around 20 crores. That compares with 2 crores in the previous quarter. And on a year-on-year basis, it compares with around 15 crores. But that was with rent concession. So this time around, it's without. So explain that to us. Why is it 20 crores? It's an elevated number.
Yeah, so this is basically the indices treatment on the rent saving. So this is a accounting process. So there's nothing, unique to that. There's no transaction there, Rijal.
All right. If you could give us a sense of online. I mean, last year you crossed about 1,000 crores in terms of online sales. At the halfway mark, where does that number stand? You had again guided for, a 10% faster growth online as against offline. What's your target for this year?
So online continues to be a very dominant channel for us. So if I look at from COVID days, we've grown at a more than 20% CAGR. In this quarter also, online is among the highest revenue quarter for us. And it's at 26% of the revenue mix for us. So it's a strong channel, and our target is to grow at more than 20%. So we are going really well on that. We are market leader in the online business in our industry. And now the focus is shifting towards even more omni linkages. So we've added 300 more stores with omni linkages in this quarter too. Also, wherever we've added omni linkages, those stores we get high single digit sales contribution coming from the omni linkages. So online continues to be a strong, and the way our brands are more casual, informal brands like US Polo or Calvin Klein or Tommy Hilfiger, they do really well on the online space, market leading in online channel.
26% of first half sales would mean that at the halfway mark, online sales would be around 520, 530 crores for you as a proportion of.
So this quarter in Q2, our monthly run rate is more than 100 crores. Okay. And, we are, looking at a business which is upward of 1,000 crore NSV in online business this year. So it continues to be a strong part of our business.
So you are on track to grow that business 25% year on year. The other thing that I wanted to know is that, how do you position Sephora against Nykaa? Because Sephora, about 200 crores in terms of run rate, profitability is pretty minuscule. But again, I mean, is there any chance of you unlocking some value out there? You had medium to long-term targets of what, 500 crores in terms of sales from here?
Sephora is very clearly positioned as a premium than the other businesses that you mentioned. Also, it's a very offline-driven global concept. So we follow the global philosophy of the brand, and we have 26 stores in the key mall in India, and women love to shop at those stores. In fact, in Q2, our like-for-like store growth of Sephora is more than 30%, among the highest for any brand. The sales density, that is sales per square foot we deliver, is among the highest in the industry for any brand in those malls. So we are very happy with the way Sephora in its own, prestige image is doing. We cannot compare with some other which are slightly lower price, little more mass appeal businesses, but we are quite on track for our game plan on Sephora.
Sailesh, we get the brand, we get the pricing. Mangalam and me, we have a very close look at these, rest assured. But is there some unlocking that you're planning? That's what we're getting at. Because shareholders, they look at your business and then they see what value is there for shareholders. So do you have some plan in mind? You're looking at scaling up this business from around the 200 crore run rate to around 500 crores. But is there an unlocking plan? Go ahead.
So we are quite engaged with Sephora to grow the way the Sephora is globally positioned as as a prestige brand in the offline space, and we'll continue to deliver that promise to our women consumers in India. So we don't have, we cannot discuss some other plan right now, but our focus is continue to run the Sephora stores.
Take your point. We will, however, closely monitor all the developments out here. Thanks a lot, Sailesh, for joining in. Target over 4,000 crores this year in terms of revenues. Run rate of 100 crore plus in online businesses with improvement in margins in the second half is what you are guiding for. The street likes that. The stock doing well. And sitting with a gain of about 2%. We take a short break. On the other side, we have another management for you. Saurabh Mittal, who's the MD and CEO of Greenlam Industries, joins us. Well, it is all about earnings, so let's get cracking with Greenlam Industries. A decent quarter for them as the margins improve on lower input costs. Revenues too came in high by 14% in the quarter gone by. Saurabh Mittal, who's the MD and CEO at the company, now joining us to tell us more. Saurabh, a bunch of questions. First half, your revenue growth was around 25%. You have said in the past that this year it'll be 20 to 25% sort of top line growth. So you're on target for that. Just wanted to understand that, one, for FY23, is that on board? And secondly, more importantly, FY24, what's your revenue growth target for that one? Because you will have some more capacity come on stream as well.
That's right. So FY23, I think we should be in that band of 20-25% revenue growth. For FY24, we'll have new capacities of plywood coming in production by Q4 of this financial year. That's available for us in FY24. We have the Naidupeta plant in Andhra Pradesh, where the laminates factory will start by Q4. So we'll have that capacity available for us. And the Gujarat facility, where we are upgrading the facility, the expanded capacity will also come to us in Q4. So if you look at FY24, besides the existing manufacturing facilities and products, we'll have addition of the Gujarat's full capacity available to us, Naidupeta's laminate capacity available to us, and ply capacity available to us. So it will depend on how much we can utilize the capacities in FY24. But clearly, I think as far as revenue growth is concerned, it'll be a reasonably good growth on the top line side in FY24 too.
Can you do two back-to-back years of 20% at least? You explained us the capacity is 20%, 20-25% should be par for the course in FY24?
So with the capacities we are putting in, and in FY24, the particle board capacity will come in stream by Q4 FY24. So if you look at next 2-3 years, so with the capacities we're putting in, I think something like a 20% plus minus is clearly doable and possible.
Right. I say this because the last time you joined us, you said that the entire capex that you're doing would cost you around 950 odd crores, and it can result in revenue addition of close to 15 to 1600 odd crores over the next 3 to 4 years when all these capacities go on full stream. So to that extent, just wanted to understand how much of that will accrue in FY24, 25, and margins. Are we likely to see them improve because chemical prices have come down?
Sure. So on the capacity, since we spoke last, I think the Gujarat factory which we bought, has got added to that number. So that'll also add about 200 odd crores of potential, 225 crores of revenue potential. So in total, with the investments in Andhra Pradesh, Tamil Nadu, and Gujarat facility, we can add approximately 1700 to 1800 crores of revenue on full potential, which I think will happen over FY20, some in FY23, FY24, 25, and 26. I think that'll be more like the, so over the next 3 financial years, and if you add this year, over 4 financial years, all these facilities will, come into meaningful capacity utilization, and all the revenue should come to the balance sheet. Okay,
let's focus on profitability then. We've gone on enough about the top line. Tell us about margins. Do you see scope for improvement from here on? Earlier, you were talking about 11.5 to around 12%. So is it moving in that direction? And the veneer business, breaks even next year or in the coming couple of quarters?
So if you look at the margins on the laminates front, we are over 12% in Q2. And we've also had, some challenges in certain export markets, which are in the emerging countries where there have been currency crisis in those countries. So despite having a good order backlog, we've not been able to ship to those markets. There's been some initial stabilization loss at the Gujarat plant, which we bought. So on the margin front, I think with utilizations getting better and with certain raw material costs softening, we hope the margins will, improve as we proceed. On the veneer business too, if you see Q2, overall the revenues grew well, about 25-30 odd percent. Revenue growth was there. Q and Q and in your sequential, on a sequential basis. The challenges were a little bit on the RM cost. So we have taken some price hikes in the veneer and the flooring business. So there still is a small EBITDA loss, and we hope that we come to EBITDA profit at the soonest.
When?
Well, the endeavor is like immediately, So clearly, maybe next 2-3 quarters we should get there.
All right, we take that point. And working capital days, you've improved your working capital days by 8 days in the second quarter. What's your long-term target out there? Because at 69 days as well, despite the improvement, it is stretched.
Well, if you look at because we're in the decorative segment, yeah, so we have a large number of SKUs. Most of the raw materials are being imported. So if you were to dissect that between laminates and veneer, in the laminates business, our working capital days is about 15% of sales, which is likely nearly about 45, 47 odd days. On the veneer side, because the revenues are lower, that's where the small challenge is on the working capital days. But I think we should keep improving this as we gain more revenue and more size and scale. In the new facilities, clearly the working capital days will be lower than the existing business model because most of the RM is local there, and sales are also going to be in the domestic market.
Final question then from my end. What about your retail presence? You said you've expanded it by launching an experience center in Ahmedabad, etc. How much of your revenue do you expect to come in from your own retail channels, and how much will you invest in increasing your retail presence?
Right. So we're not selling from these experience stores we're building. So they're really for an experience, for the influencers, for architects, IDs, homeowners, dealers sending in their contractors. So these are not revenue points, but they're demand generation points to support our channel partners and our influencers. And we're gradually ramping that up. Now we have 2 company-owned, company-operated centers, one in Calcutta and one in Ahmedabad. Besides that, we do a lot of retail displays, shop-in-shop displays with our channel partners.
Right, we get that. But quickly, if you could tell us, how much will you invest in these? Because these would be for branding.
So our marketing spend is, I can give you the marketing spend figure, not specifically for the experience centers at the moment.
All right, take that point. Thank you so much for joining in and giving us all those details. Wish you good luck for the remainder of this year. And with that, we are out of time of this edition of Chartbusters. That, ladies and gentlemen, was the management of Green Lamp. Thank you for watching.